Good morning, everyone, and welcome to the first Investment Insights of the week, where we're covering our global range of funds. Today, I'm really pleased to have with me Ian Beattie, co-CIO and founder of NS Partners, and also the portfolio manager on our Nedgroup Investments Global Emerging Market Equity Fund. Well, we chose NS Partners because they have an enviable 25-year track record that doesn't get a lot of airtime. But if we look at that 25-year track record, they've consistently outperformed the MSCI Emerging Market Index over that period. And in fact, if we look deeper, we can see that if we measure rolling periods of 1 year on a monthly basis over that time, you can see that they've outperformed the MSCI index in 75% of the time, producing an excess return of 3% over and above the index on average. One of the reasons why we partner with NS Partners is for their unique investment philosophy. Like us, we believe that they believe that country selection matters. It doesn't matter if you're in the best company in Turkey if the currency and the stock market in Turkey is going in the wrong direction. Please submit your questions for Ian or myself. On the right-hand side, you'll see a Q&A chat. We'll be getting to those after the presentation, but first up, I'm going to hand over to Ian to take us through some of the drivers of performance and the portfolio positioning for the latest quarter. Ian, good morning, and thank you very much.
Good morning. Thank you, Rob. Well, I'm going to go through and give a quarterly update. I'm going to spend a bit of time talking about the performance, the attribution, what we've done, and then I'm going to spend a bit of time on some of our macro work to say where we think markets are headed and how that will inform how we're positioning, and I aim to leave lots of time for questions. Okay, so here's the performance. Over the last 3 months, the portfolio's returned 9.97%, which is just ahead of the MSCI Emerging Market Index, but that brings the year to date to a positive 2.93. Of course, the index is down slightly, and 1 year up 16.3, and the index is only up 10.5, so a little bit further ahead on those longer time periods, but ahead over all time periods. And since inception, with Nedgroup, this fund's up just over 8%. The index is up over 2.75. A quick firm update. We're running just under $700 million in emerging markets now. Our boutique firm as a whole is just over $3 billion US, and part of a group obviously with a lot more under management. No changes in our investment team. We have added to our non-investment team though. We've got some ops and support people, both of whom we've hired over this period, one of which we've known for a very long time, worked with one of our counterparties, so we sort of stole those, I suppose you might say. And the other one, we did do this rather unusual environment, hiring, interviewing and everything else remotely over this COVID-19 period, but shows that we're in a growth mode, I suppose. We're still, most of the firm, just over the majority of the firm are working from home most of the time, some of them all the time, but we have some people that are starting to return to the office, all COVID secure and all risk assessed. Life is starting to get back to normal, but not fully yet. So onto the performance, onto the portfolio. This is like a summary page we have, so that if you want just the one pager of the story, this is the one that you want to be looking at really. So I've talked about the numbers already. I've got the since inception and year to date ones on here. But what worked year to date in 2020? Well, stock selection's been very good. And stock selection in China, in particular, Russia and Taiwan has been exceptional. Sector selection has also been positive. I think you needed to have reasonable sector selection year to date. If you haven't got your Chinese consumer discretionary or IT names in Taiwan and China or in the rest of emerging markets, you would be struggling, as you would be probably in a global portfolio as well. Underweights in energy, utilities, also worked, and recently healthcare underweight worked again, but didn't over the longer period. Stock selection, it wasn't all our own way though. Stock selection was negative in India and Indonesia, consumer discretionary, specifically in very strong markets there in the retail and travel related names. Still not a time to be owning anything in travel, as I'm sure you can imagine with the COVID-19 lockdown still in place in many parts of the world. And some of the semiconductor and internet infrastructure names didn't work over the more recent quarter, but have done very well again over the longer period. So if we sort of name 3 good and 3 bad, which we like to do just over the shorter time periods, then our solar company, Longy Green Energy, has done fantastically well. This is a manufacturer of solar energy systems, and it really has got to the point where the scale is kicking in and it's becoming a competitive advantage for them. We see some of these markets, EV batteries and solar, as reaching a point where they're starting to oligopolize. They're very much about scale and technology, and you have to keep the R&D and capex spends up. And when that means that at a certain point, a few companies become more dominant. They're the ones that can keep their capex spending, their R&D spending at high levels in dollar terms. But as the scale kicks in, as a percentage of the income statement or as a percentage of the balance sheet, that starts to fall. And then, of course, the returns on invested capital surge. And that's happening with a few stocks in the portfolio at the moment, including Longy Green Energy and solar, and LG Chem and Contemporary Amperex in EV batteries. LG Chem is the next one on the good list this period. Fast growing EV battery maker in that oligopolizing market. This is a story that's very natural to us. So they're manufacturers, but they're in high growth areas, and they've really kicked in and really paid us this year. Reliance Industries is in there. It's basically the only energy company that's done okay, and it's quite a big stock, and it's made a positive contribution. If you look at the attribution on a sector basis, it's up. The rest of the sector is down, so it looks like it was good. And of course, it's not driven by the energy part of that business. It's driven by the retail and the telecoms and internet partnerships that it's starting to make. Didn't all go our own way, obviously. We've got Win Macau, which is obviously in the hospitality industry. That's definitely not been the time to be owning those sort of names. We've started to look at rotating the portfolio, and initially the Banco Bradesco is still not working yet, although have high hopes for that going forward. Very conservative bank, so lots of conservative provisioning going on with non-performing loans, but we think they'll start to reverse as the recovery starts to come through. And Mint Group there, wasn't so good early on. What have we done over the period? Well, we have started to take profits in the high growth consumer names, in the internet names even, and IT and media. And we've started to add to the economically sensitive names. I'm trying to avoid the word cyclical. The economically sensitive names in China, Korea, Taiwan, Brazil, and even Mexico. So that's the pattern. That process is still ongoing. So this is more backward-looking charts of what's happened, performance for the various countries. You can see there Brazil doing very poorly at the bottom, South Africa doing very poorly at the bottom on the right-hand side, Mexico also doing very poorly. And we've been underweight Mexico, very, very underweight South Africa, and have been underweight Brazil over most of that time as well. Just starting to add to the Brazils and a little bit on the Mexico, but really only one stock. China's been very good, obviously, for us and for everybody over this period. Tempted to start using that as a source of cash, but risk reward wise, China looks pretty good actually. Not the most exciting story from here, probably in the short term, but it's looking like a V shape. It is a V shape basically in China. That's beyond doubt now. Earnings are starting to come through, and there's some great stock names there to pick. India doing less bad, I think, than everybody expected on the left-hand side. Taiwan continues to do very, very well. We did take some profit from that market during this quarter, but we're actually also rotating within it and starting to buy other names within it. It's a very, very good set of companies there to choose, and Taiwan dealt with COVID-19 incredibly well. We would all know about that if it wasn't for the fact that the World Health Organization doesn't recognize Taiwan. I think I'll skip on for there as well. So attribution by country, this is our performance now, and you can see we didn't really score that much on the country selection. It's like negative on there, but we did do well in the stock selection. So when you net those off, it's been a reasonable period year to date, just under 4%, 3.87% outperformance, driven very much, as I said earlier, by the China stock selection and by Taiwan stock selection, and in emerging Europe as well, a very good performance there, especially in places like Poland, where we've now taken profit actually, as well as some of the underweights. And I think this is a familiar picture on the sectors. You're probably getting this from all your fund managers, whatever region they're looking at. Energy at the bottom, consumer discretionary, especially if it's internet related, at the top. We also, of course, in some countries have consumer discretionary doing well, and textiles if it's in the sports leisure wear theme we've been very strong on for many years now. Obviously it's Nike in the US and Adidas in Europe, and in China it'll be a company called Li-Ning, which is a solid name for us in our portfolio, has been for quite a long time. Again, very familiar picture elsewhere. If you're not sensitive to the shutdowns, the COVID-19 shutdowns, and you have a strong internal growth driver, then that sector's outperformed significantly. If you are sensitive to it, then you've done very poorly. Interesting to note, utilities still doing very well, so it's not defensives that are being fueled by all the liquidity. And then onto the individual stocks. I've mentioned most of these already, so no point in me singing my own praises again. On Long E Green Technology, that's the solar one. LG Chem, which is the batteries. Reliance, the energy name that didn't go down. And we also have ESR Cayman, which, although it's under real estate, it's really a manufacturer of REITs. It's a real estate investment trust, and it specializes in, it's a manager of real estate investment trusts, and it specializes in logistics sheds, e-commerce sheds. So obviously that business is doing very, very well as well. And I think that finding a real yield is going to be very difficult going forward. So something like this that is effectively creating products with real yields should do very well, as well as that real yield itself being attractive as it starts to develop one going forward. Naver is another internet name, obviously doing well, as is the rest of the sector. And then if we didn't have enough in some of these names like JD.com, they're hurting us because we don't own enough. So it's, you know, it's a extreme bull market when that sort of thing's happening. And then we've got a collection of banks and tourism names on the bottom 5 detractors. We are not looking to sell those. If we thought there was a problem with the business model or a problem that was insurmountable in that business, we would have sold them already. Indeed, we have sold some things that we thought were not working. These ones we think have strong business model, have good cash flow generation or good cash flow generating ability, and we think they'll come back very strongly going forward. So what did we do over this now, zooming in over the third quarter now? Well, we actually moved our JD.com weighting from the US into China. So that's a bit of a confusing picture there, but otherwise we've got AirTac, which we think will do well as the PMIs are increasing now in many parts of the world, but obviously China was the first up. This is a automation play. So as factories automate, and when they spend, they'll be spending more on automation in expansion. Companies like AirTac will do very, very well. You see Spring Airlines in there. Probably people are a bit surprised that we're going into airlines already. This company is a low-cost carrier, so it's got a strong business model, and China first out of the COVID-19 weakness. That's a V-shape for sure. We'll look at the charts on that later on. So as we started to add to these economically sensitive names by buying even an airline, but it's an airline that's a low-cost carrier, good business model, not a flag carrier. Old favorite TSMC getting a top up there as well, and Power Long Real Estate really seeing very, very good. This is a good old-fashioned, seeing great sales momentum, and it was also being a southbound Hong Kong Connect beneficiary. So mainland money can buy this name for the first time in Hong Kong. Two small positives there, which we thought would be quite good, and indeed it's done very well for us already. On the sales, a lot of profit taking here. Profit taking in a very strong growth name, Giant Manufacturing. We bought this in the lockdowns. It's a bicycle manufacturer, really strong in e-bikes as well. Don't know whether you noticed, everybody's riding bikes again. People are avoiding public transport. and there's a big demand for e-bikes. Giant's one of the major players in here. It's a very good company we've known for many years. So we bought that, in the market collapse, and it did very, very well. And we've been a bit cheeky and taken profit already. Largan, we think, struggling with the Huawei orders losses. Tencent, we're just taking, that's basically a source of cash. Really like Tencent still, but we've been reducing a very large weighting. We call it profit taking, but it's also moving this capital away from the growth areas, rotating into the more economically sensitive areas, especially in China. But that's no negative really on Tencent itself. It's just a very, very big stock with very, very large weightings, and it's done very, very well. LG household and healthcare, their company profit was impacted by a lack of tourism, even though it was considered a consumer staple, and we sold that one very early during the lockdown process. And Baidu there, just don't think it's really executing as well, although it is an exciting story for autonomous driving. It's going to spend a little bit of time on the global economy and also the emerging market economies. And you can see here, if you add the G7 and the E7 together, it looks like we're getting a V shape. Money growth surge suggests to us that we'll still have a strong 2021 economy at the beginning of the year. Also, we're aware there could be some medium-term pricing pressure in certain areas, and that's going to look like a medium-term inflation upswing. We're not interested in speculating, longer term, whether this is going to happen, whether we're at a turning point. We're looking at the data, and the data suggests that's what's happening. 90% plus output fall was 90% of the output fall was retraced by August alone. This is so much quicker than obviously a normal economic slowdown. So we're looking at the V shape completing around now in many countries. This is a 3-quarter turnaround when, as we looked at the GFC, it took 3 years. It's a very, very different recovery going on. But as I've mentioned on these calls before, if you bring the economy to a hard stop and restart, you're going to get tremendous year-on-year numbers or month-on-month growth numbers as well. But this was a huge policy response. On the right-hand side, you can see nominal GDP there collapsing, and then narrow and broad money surging. And these numbers, again, as I've mentioned before, are the highest we've seen if we look historically, almost anywhere. You go back to the US Civil War to see numbers like this in peacetime. It's certainly a wartime response. So going into a bit more detail, you can see V-shaped recovery in industrial output in many areas. Retail sales actually surging. So obviously we're seeing a different pattern for retail, but the spending is coming through. And you can see global PMIs, you're going to get a very big inventory boost to this pattern. The Chinese economy is the one that led the way in both down and now up. Growth pickup is extending to services and consumption, and the financing in China is looking easier, i.e. it's much easier for companies to get financing now, and industrial profits have bounced already. So that China is the one that is a V shape without doubt. If we look at the other emerging markets, the money supply is huge. We're actually a little bit nervous about Brazil's because that is so fast. I think if the Fed wasn't doing the same, we would be concerned. But all of those, you've just got to say really it's generalized strength, and maybe we need to be a little bit wary about Brazil, depending on what happens in the US really. And we have our checklist. Now, this is not really that about how we're running the money in the fund. This is more about if you want something to help timing on when you own emerging markets or not. Now, often this doesn't give much of a steer, but it is very useful at turning points for saying whether you should be bullish or bearish. And we think of it as like a traffic light system. So the more red on here, the more bearish. The more green, the more aggressive you want to be, the more bullish. It's as simple as that. Now, it's been many years since we've seen this checklist look as positive as this. So real money growth is the only one in the red. And that's a bit weird because they're both actually really positive. It's just we've never seen the G7 quite so strong. We've never seen the E7 so strong, but the G7 led by the Fed is hugely extreme in its money response. Now, normally, as I hinted with Brazil, if you see a money number as strong as the Fed's showing, we'd actually be negative on the currency and worrying about profligacy. and I'm sure many of you are worried about the fact that the Fed is now experimenting with the monetary and the rest of the government with fiscal policy at the same time, as are a few other countries. So I think from a risk reward point of view, and depending on whether you're after equities or bonds, you start to think that maybe those countries that are not experimenting, that are sticking to economic orthodoxy, like the People's Bank of China, might be a better long-term risk reward bet. But our process and our system would be saying that is still negative for emerging markets and to back the G7. But like I said, this is an unprecedented number. Pretty much everything else is now positive. Earnings revisions, they're broadly the same, so we leave those as at a neutral. But valuations are certainly lower in emerging markets relative to developed markets, and in their normal, sort of mid-range on their own absolute terms since the GFC, or in the GFC range, but definitely much cheaper in EM versus DM. Global industrial cycle, well, that's in an upswing. As you see on those charts, that V has started, and emerging markets generally like that point in the cycle. They also like excess money globally, and of course, yes, we certainly have that. I'd be tempted to make that a double tick if we had such a rating. Positive real money and a massive gap with the demand for money, i.e. industrial production. Commodity prices are in an upswing because really we're talking about industrial commodities here. Emerging markets, some of them are consumers of oil prices. The biggest ones, China and India, are oil price importers. So really we're looking at the other industrial metals here to see whether, where we are in the cycle. And I think we've got to say that is in an upswing, not as strong as the other three, but we're in an upswing. And the dollar, well, I think we can say that the bull market is over in the dollar. It certainly is at the moment. So we put that as a tentative yes. Whether that long-term trend is broken or not, I'll leave you to make your own decision on that. But overall, this is a very, very strong set of charts. That's a checklist. So our strategy, very clearly, unprecedented fiscal and monetary stimulus will drive a strong recovery in the second half of this year and carry on through into 2021. Equity markets will discount a return to growth, and I believe they're starting to do so now as these infections peak and start to get under control. In fact, a second wave peaking would probably be very bullish towards that. This is enabled, of course, by the liquidity. The animal spirits are fed by the liquidity that enables markets to look through bad news. The emerging market checklist is becoming more bullish than it has for years. Now we have been overweight IT, internet, consumer discretionary, because those are the long duration names that are pretty impervious to COVID-19 lockdowns, and they have been fed by this liquidity. But we have started to add to economically sensitive stocks and therefore take profit in those names as markets and the liquidity gap reduces while the economy recovers. We're overweight China, but we're adding to those cyclical markets like South Korea and even Brazil. We're underweight Taiwan, despite the fact that it's a very, very good story and some great stocks in there. We're very underweight South Africa, Mexico, and the GCC. While we remain focused on the high quality, high and improving return on invested capital companies, of which there are plenty in the Chinese mainland, we are finding more and more improving return on invested capital companies to invest in. So we've had a great opportunities to pick up some quality names and some quality growth names. But again, as I said, starting to play the recovery through these economically sensitive stocks and indeed countries. So unusually for me, hopefully I finished in time for some questions.
Ian, that was brilliant. Thank you very much. We do have quite a few questions coming through. First up, I'd like to touch on your views on EM versus DM performance going forwards. And also, if you could, one of the other questions we had is, and I think you touched on it earlier, but EM's underperformed DM in the last decade. So why is that going to be different going forward? And I think, yes, you've come up to this slide. I think that you touched on it, but is there any more meat you have on?
Yeah, so I've got a few charts within this, but I'm just going to pause on this one for a while. We think this works really well to give you an indicator of EM versus DM. Now, emerging markets have changed enormously over the last 10 years. Obviously, there's a lot more tech, there's a lot more growth. You could almost say we've arrived at the Pacific century, because actually the reason why DM has outperformed EM is because you've got those US West Coast internet and technology names. And you've sort of got the similar thing going on in China, in that you've got Hangzhou and Shenzhen domiciled. You've got the Tencents, the Alibabas. If you just had a portfolio of the China tech and the US tech, that's where your performance has been in both universes. So it's really about the balance. But actually, as we go forward, I think we're in one of those areas now where the cycle is turning, and emerging markets historically have liked that. So this is the checklist we use to assess that. Yes, it's not 100% in the green, but this is the most positive we've seen for some time. And the one that it isn't positive on is a little odd. So if I go through, I've got a few charts here in amongst this massive appendix. There. So here's the Chinese economy, which is actually looking the most normal now. We've got this big dip in nominal GDP, but now starting to see it accelerate, and very, very normally we would say these are very, very strong money numbers. It's just that the rest of the world seems to have gone mad and money numbers are shooting off the scale. China's not needed to. When the People's Bank of China tells a banker to lend, they lend. So they don't have to overdo it. And you can see on the right-hand side, the financing conditions are easing as indeed that happens. So moral suasion still works for the Chinese Communist Party and the People's Bank of China, and their bankers are being obedient. If we go through the rest of the checklist, you can see here, we looked at this chart already on the left, but you can see that's the only one that's negative, and they're both really strong and really powerful money numbers. I would be worried that the blue one, the E7, so the G7 led by the Fed, is almost too strong. On the right hand side, you can see valuations. They're a lot cheaper, but we all know valuations can stay cheap for a long time, but they do have that very powerful valuation gap, very large. Revisions ratios are broadly the same. But on the right-hand side there, you can see lots of liquidity to feed what we would probably call the periphery if you're using a core periphery model. Raw materials starting to rally, and it's these raw materials that I think are important for emerging markets, not energy. In fact, if anything, they're probably negatively correlated to energy. And then the dollar on the right-hand side, well, it's unwound that massive spike that was associated with COVID. Now, if that breaks, then we will really be banging the table on emerging markets in a very, very extreme manner. But you can see there's a lot of support there for emerging markets, more than we've seen for many, many years.
Okay, thank you very much. And you touched on raw materials there, Ian. We've had a couple of questions on China's infrastructure spend, and does that need to ramp up to be good for the commodity producing economies?
Yeah, that's a good point, Rob. I would say that yes, China's doing an infrastructure boost, and we have names like Sany Heavy in the portfolio, and Anhui Conch. So Sany Heavy is a really good quality construction materials, construction equipment maker, like a Caterpillar or something like that. And we think it's going to become one of those big global players. But at the moment, it's still being very dominant within China, and we've seen their market share increase tremendously over the last few years, and their quality increase tremendously. They've become a very good quality name, very good quality product, and we've been talking to their customers and seeing how that's changed. We've got Anhui Conch, we've even got some Jiangxi copper. So we're positioned for that infrastructure spend, but I don't think it's a big Chinese fiscal boost infrastructure spend like we saw in the past. I think they don't feel the need to do that because their bankers are lending, and they see the rest of the world doing their boosting, their fiscal and monetary boost. So they're not doing the same as they did in the GFC, where they rode to the world's rescue with a massive infrastructure campaign. They're still mindful that they're in a deleveraging and a sort of, they want more sensible investment, which is a good thing in the long run, right? So yes, they're doing it, but it's in a more measured way. They're certainly not going crazy like the rest of the world is at the moment. And you've got to I think you've got to bear in mind that Xi Jinping came to power on almost against the previous administration's actions, saying we mustn't do that again, we mustn't go crazy on spending and have all this malinvestment. So it seems a lot more measured and controlled, a lot more about tech as well. So that a lot of the infrastructure spending this time will be in technology, on cloud, AI, and 5G.
Thank you, Ian. I had a couple of questions come through on corporate governance or ESG risks in China. And does that worry you, and how do you handle that issue for China in particular?
Yeah, corporate governance and another ESG risks, but corporate governance in particular has always worried us for a long time. But I would say everywhere. China, yes, has its different risk factors, and when we look at companies, we tend to restate the accounts anyway and look for accounting anomalies, look for aggressive accounting techniques. We run a number of screens to see if there's anything that's a bit fishy, and we don't rely on street research or broker consensus or anything like that. We want to make sure that it passes our test, and we do our own models really for this very reason. Not because we think we're modeling better, but if we've done the model ourselves, then we're more likely to spot something that doesn't quite add up. Is there lots of cash but no dividend, for instance, to take a really easy example? But we also run a series of other screens on the accounting of companies to see whether there might be something a little bit untoward. And obviously we check for good governance, non-exec directors on the board, things like that. And I'm very proud to say most of our companies have that, and have that much better than their peers and the rest of the universe. So all that very basic stuff, you've just got to stick to those basics and do it. I would point out that a lot of this is cyclical. If you have a weakening economy and lots of liquidity, it's when you get the aggressive accounting picks up, and we saw that with Wirecard in Germany and things like that. So we've had a lot of frauds all over the world. Yes, we do have a lot in China, but some of the worst ones in China are those Chinese companies that have listed overseas. Always a little bit suspicious of a company that lists somewhere where it isn't domiciled. And why? Those are questions that management need to answer sensibly to find out exactly why they're not listing where they should be. Now, I know there's sometimes historical reasons, so one was once the dominant company invested in another, and so on. So that's sort of understandable. You can see how the companies ended up in that shape. But if they've deliberately listed somewhere odd, then we have to be cautious, I think.
Yeah, thank you very much. Just a couple of quick questions. I appreciate we're over time, but we had a question come through. Do you have any thoughts on the Ant Group IPO?
Well, Ant's a very, very exciting company. I worry a little bit that they might have missed the best timing for that sector and for that sort of type of long duration stock. It is very exciting. We are still going through the analysis on it at the moment. But it's an incredibly exciting area. It's not like some of the other fintechs that have come and listed. It is in more exciting areas. It does have a better business model. So yeah, bear in mind we've still got a little bit more work to do, but initially we're saying very exciting, genuinely is a very exciting business model. It's the real deal, I suppose, is the best way of saying it.
Thank you. And you mentioned that you're very underweight South Africa. What do you need to see to change your opinion or change your enthusiasm for the country?
Okay, well, there's two things we're looking at. Obviously, there's shorter term and cyclical things, but the really long term one is we need to see an improvement in that governance we were talking about. So probably unusually amongst my peers, really, but probably not surprisingly. When we look at governance and institutional quality, we look at that on a macro basis as well. And South Africa, obviously, although actually I think scores higher than many South Africans think, it's going in the wrong direction. It has been going in the wrong direction for a while, and that's very poor. So South Africa, obviously, as in many ways, both economically and from this governance perspective, has many advantages and scores very highly in some things and then very poorly in others. And in the total, it is drifting lower. It's very unusual to see a company in our universe go lower on that score, but it is unfortunately going the wrong direction. So that's basically it.
Apologies. And then finally, does scenario analysis play a big part of your investment process?
That's sort of a good question. Yeah, we don't really. We find it's better to. We're aware of all the different scenarios, but we don't put them in a model and weight them like I know some people might do, or they certainly like they used to do. So not the way probably the person asking that question is thinking of it. We are of course aware of all the different probability percentages and of various scenarios, but we don't model them probably like some people would when they call it scenario analysis. So we're very much more what's our conviction in the forecast, and we probability weight that, and then we focus on as that changes. So we're more of a tweaker of the forecast as the data changes. And then we think that ties in very well with how you run a portfolio. We think that helps you sweat the capital harder rather than pretend that you've diversified everything away under all scenarios, which can go very horribly wrong, we think. So we prefer, in order to sweat the capital harder, to have our forecast and look at the percentage, the probability of that, and tweak that all the time. And then that feeds through into our portfolio and our capital allocation, we think better. And it just means that we take less risk for the same return, and you just make that capital work a little bit harder. And over the long run, we think that generates slightly better returns for slightly less risk, which is what we're all trying to do all the time, isn't it? So it helps that more. Our process is a bit more hard work, a bit more sweating the capital, and a bit less sort of thinking and spreading out risks that we think can lead to pools of capital not working for us.
Thank you, Ian. I'm going to leave the questions there, but it would be amiss of me if I didn't ask you if you were happy for the other West Country teams that triumphed in Europe this weekend.
Shifting uncomfortably in my seat. Yeah, I suppose so, grudgingly, given that they've all done it. Yeah, not my West Country team, but yeah, well done, Exeter. Although I thought Racing were probably a little bit unlucky. But if you gift away 2 easy tries, that's what happens here.
Once again, thank you very much for your time today, Ian. It was really insightful and helpful for all of our investors and potential investors out there. And I'd just like to thank you on behalf of my children, who are all invested in the fund through their tax-free investment. So regular contributions coming from the Johnson household. Ian,
thank you.
And on that note, say that again, sorry.
Thank you.
So on that note, thank you to everybody who dialed in today. Tomorrow we have our update with Andy Headley on global equity, and in the morning, and then in the afternoon we'll be catching up with Brian Selmo from FPA for our global flexible fund update. Again, Ian, thank you very much, and for everybody else, have a good day further. Bye-bye.